There aren't many bright spots in today's market, but one of them, Treasuries. Let's bring in Janney Chief Fixed Income Strategist Guy LeBas. Elizabeth McDonald is also joining the conversation. Guy, I would argue, and you can completely shoot this down if you want to, that at least the high yield market, and when it started to weaken early last year, it gave you a sense of the weakness that eventually showed up in stocks and in parts of the stock market. Where are you seeing weakness in fixed income right now?
Sure. Good morning, Dakin, and thank you for having me. You hit the nail on the head right there. I mean, the high yield markets have had a very rough, really 6 months in particular. You know, the beginning half of 2015, the pain in high yield was really isolated to energy-sensitive companies, and since, call it June or so, it really widened out to a much greater swath of the high yield markets. The truth is we're pretty early on in the credit cycle and still probably have a little ways to go down in terms of high yield pricing. But as you can see this morning, you know, Treasuries remain the global safe haven asset of choice. No matter how dinged up the U.S. credit quality and economy has been over the last 2 years, investors still flood into Treasuries in times when there's overseas distress we're seeing right now in foreign equity markets.
And I would argue at least some of that, or it was what I was talking about earlier with Stuart Varney, is you have individual investors that have been slammed, starting with the tech collapse, then the housing collapse and the financial crisis, and just what you're seeing here. Guy, how low do you think that the yield on the 10-year can go?
Well, our expectation for the end of the year is about unchanged, 222. But in the meantime, I think there's a trading range that's probably in the neighborhood of about 2 to 2.5% or so. I would point out that even though we saw a big rally in Treasuries overnight with the Chinese equity meltdown in particular, this morning when New York traders hit their desks, we've actually been selling off from those highs, from that high point. So I don't think this rally today is really going to be sustained. If anything drives yields towards the lower end of that 2% range I just mentioned, it's got to be a few pieces of negative economic data in the next few weeks, which I don't see coming, frankly.
Yeah, go ahead.
Oh, sorry. If you just kind of study the history of it all and you see that corporate earnings, when they go negative 2 quarters in a row, we've been talking about this morning, you always end up having not a recession, but you have a stock market crash or a 20% decline. Like, if you see corporate credit reacting to corporate profit slowdown, which is a pretty simple relationship, why wouldn't the 10-year bond yield retest its all-time lows?
Well, the way we look at 10-year yields right now is they're subject essentially, mainly to one factor, which is the peak of the Fed funds rate in this current hiking cycle. And so that peak rate got priced in 2015 all the way down to a little bit under 2%. And I really find it hard to believe that the peak of this rate hike cycle is going to be priced in much lower than that.
Exactly.
And so that's really what provides a floor in terms of 10-year yields.
I think Guy is right, Dig, and guys, I mean, talking to Goldman Sachs and Bank of America, Merrill Lynch, the high yield market really started falling out of bed. And it's almost, if you link it to the dollar strengthening, it almost equates it, and when you see the action there. And what they're talking about right now in the trading pits, the guys I talk to, not just that earnings per share growth is supposed to come down for this quarter by anywhere from 4.9 to 5.6%. They're talking the average S&P stock down 19%. That's pretty much correction territory. They're talking about what the Fed funds future is now talking about, or pointing toward Fed rate increases. We know the median view at the Fed was 4 rate increases, the first in April. Now Fed funds future is saying, no way, just 4 out of 43% chance of a Fed rate hike in April, down from 52% just recently.
Guy, where do you stand on the Fed and how they'll react in the months to come?
Well, we have sort of an odd position when it comes to the Federal Reserve.
We like odd
in 2016
we like
specifically.
Odd.
Good, I'm glad
we
you
like weird and odd
person.
and freaky. Well, go ahead.
So our call is either 2 rate hikes or 6 rate hikes. And the variable which distinguishes between the two is the short-term evolution of the PCE inflation numbers. But the problem is, statistically speaking, since the global financial crisis, we can no longer say what causes inflation in the short term. All the things that were supposed to cause inflation, they just haven't, right? And so there's a little bit of I like to describe it as being agnostic on inflation over the next 6 months or so, and that differential, whether it does emerge or it doesn't, means either 2 rate hikes or 6.
I'll get really freaky. How about none? How about no more in the rest of the year? Right.
It's increasingly a possibility, but look, we're talking about 3-4 trading days in 2016. I don't like reading into that much into that short a period of time.
Guy, given that 2 or 6, and I understand your logic there, We talked about the 10-year. Where do you see 2-year yields going? We haven't talked about the short end of the curve, but obviously that's an indicator for what the market thinks of rate hikes as well. Where do you see that around, hovering around 1% right now? What's your view on that?
Yeah, our year-end call for the 2-year note is, I believe, about 160. I'm going from the top of my head. I don't remember the exact number. But the trend that we've seen, actually, is that while 2-year interest rates are rising, think about it this way. If you bought a 2-year bond 12 months ago, you don't own a 2-year bond. You own a 1-year bond today. And that bond is actually up slightly in price. So even though interest rates are rising on the short end of the curve, it's not actually hurting market valuations because of what we call the roll-down effect, the idea that your bond gets shorter every year.
Guy, it was good to see you so much. Liz McDonald,
Sure.
I'll give you a final word.
I think, thank you so much. What we're hearing, too, and Keith and I were just talking about this, when we look at the corporate earnings season coming up, we have to remember that they're reporting on adjusted numbers, right? And the company's own made-up numbers filled with a lot of white noise. And, what we're lacking in the business coverage right now is coverage of corporate accounting scandals and how earnings are being manipulated to the investor relations department point of view. And so I think that when we are in a choppy market like this, again and again, it's always trust but verify those earnings numbers, and you got to watch the cash flow. When you see a company like Nordstrom or Kinder Morgan suddenly saying, "Ooh, special dividend," it doesn't mean break out the hats and horns and crook the trumpets that all things are well, and that cash flow is great. You just got to say to yourself, they may be drawing investors in on shaky earnings numbers. Watch for that this corporate earnings season.
By the way, EMAC was the accounting reporter at the Wall Street Journal.
Thank you for that.
For many years.
Yeah.
So EMAC can smell a scandal 15 miles away.
And we just had a big stinky one with the subprime accounting fraud that was basically allowed by the rules, but that's for another day.
Liz, thank you so much. Elizabeth McDonald and Guy LeBas, thanks to both of you.